What's up everybody? Welcome to the Stocks channel. My name is Cory and in tonight's episode I'm doing another stock market technical analysis update. But before we get into the charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along with all of my updates. First up, we have the ticker symbol SPY, which is our SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. Alright, so with today's price action on the SPY ETF, we see that the SPY went up 0.64% today, as well as closing above that 20 simple moving average. We also see that the 5 EMA crossed back above the 13 EMA, which tells us that that short-term bearish trend has now reversed and we're starting to see the beginnings of a bullish trend developing. But now before we get too bullish on this market, we need to identify the risk versus the reward, and we do know that our reward is somewhere up around this magenta trend line, which has been acting as resistance. So if you're new to the channel or you just forgot about that magenta resistance trend line, that was developed by taking the lows of 2009 and the high of 2018. And we know that that successfully called the top of the market in February of 2020, as well as early September of 2020 when we had that false breakout above the resistance trend line, which did send the stock market into this correction. So it was definitely no coincidence, and we did expect to see that correction following that breakthrough because there was the potential that that area was going to be a very strong resistance level. And even though we did see a close above it, we do see the huge sell-off following the very next day, which lets us know that that was just a false breakout. So with today's price action close on SPY, we could assume that our upside price potential, which would be our reward in this case, is somewhere around 5% to the upside. So the reason I bring this up is we need to identify the risk and the reward in the market, because risk is how we identify how we're going to trade or what our position size is going to be. So with only about a 5% upside on the S&P 500, I really don't want to be all in on the market right now just because we're starting to see this correction potentially end. There's still a lot of downside risk in this market. And if we switch over to a monthly chart, you could see that we were trading above the top of the Bollinger Band just as soon as August of 2020. And now we're somewhere still very close to the top of that Bollinger Band. So there's still full potential for the market to continue to head lower. And that's why it's so critical on the daily chart on the S&P 500. We need to wait for a higher high. So going back to the daily chart, we do see the beginning of the start of a bullish trend, but we have to close back above 342 and get that higher high on the daily chart, because there's still a full opportunity that we could start this bullish trend and slowly head up to this resistance level at 342 and get rejected and come down here and form another lower low, which is just going to resume the medium-term trend, which is still bearish. So you just heard me say that the short-term bearish trend has reversed and now we're in a short-term bullish trend, but we still do have a negative sloping 20 simple moving average, which is more of a medium-term bearish trend. So yes, we are starting to see positive development, and I would suggest taking smart, small size position long trades at these levels, because you know that your risk is right below the 20 simple moving average, and you can set a stop loss or take a certain position size that will limit your risk to the downside. But there's still full potential that this bullish trend could continue to develop and strengthen, and we could still see the trend break through very strong, and we could break through this resistance trend line, and we could start developing new highs in the stock market. But I would have to say that the odds are against the bullish case. However, that doesn't mean it can't happen. So one thing I want to show to make that point is we did go ahead and do a survey on the stocks channel, and we did get what we expected, which is most people that voted on this poll think that there's a lot of risk in the market and we're going to see much more downside. You can see the next vote was basically a tie between being neutral and seeing the market go sideways, or thinking that the market was a low risk situation and we had a lot more upside. So the way I interpret a poll like this, and this isn't to be mean, but most retail investors are typically wrong about the stock market. So you can see a heavy favoring on this poll that 66% of the people that voted thought that there was a lot more downside coming and the market was high risk. So let's go ahead and compare that to our other poll that we like to watch on this channel. And we can see here that 43% of people were bearish on this poll, with the next highest being neutral, and the bullish people are actually coming in at last place at only 26% bullish. So the reason I bring this up is, typically speaking, the retail investors are going to be wrong. And if the majority of retail is bearish, that usually means that there's more money on the sidelines, because people that are bearish on the market are either shorting or they're in cash. And if they're shorting and the market goes higher, eventually they will get short squeezed. And if they're in cash and the market continues to go higher, eventually they will get the fear of missing out and they will start flooding into the market at the absolute tops. And that's when we start to see these false breakouts above these resistance levels where everybody is just FOMOing into the market, trying to make that last buck, but they're really just showing up to the party late and they're going to miss out on the ride right before the correction happens, and then they're caught holding the bag. So remember, on this channel, we do objective analysis and we follow the trend and we follow the price action. All of this other information is strictly for educational purposes and to help you put into perspective how important it is to be objective when you're trading in the stock market. You don't want to have emotions and you don't want to have to worry about timing the top or timing the bottom of the market perfectly. You simply need to have a strategy that follows the price action and limits your risk to the downside so that you don't get caught in a 100% all-in position while the stock market is tanking. And you don't want to be shorting the stock market when it's in a strong bullish trend and skyrocketing higher. So right now, with all of the bearish sentiment in the retail investors and the beginnings of what looks like a bullish trend developing, I still have to get benefit of the doubt that this market is going to start breaking to new higher highs and we're going to start seeing this bullish trend develop. So after a correction, there's no reason to believe that this long-term bull market isn't going to resume and that this was just that ABC correction before the resumption of that bull market. So the resumption of a bull market would look just like the start of the original bull market, and we're going to start seeing that impulsive move set the direction. So right now, after this correction, which we could assume this ABC correction is now done because we have consistent follow through to the upside after the end of that C wave, we're now generating our impulsive move, which is starting the next trend on the bull market. So when this trend comes down and we start to see 2 or 3 days of selling, we're going to view that on the stocks channel as a buying opportunity. And once we see the bottom of that pivot, we're going to buy in and set a stop loss below that position while we get ready for the next run up on the stock market. And we want to have a position long in that situation because there's going to be a lot of money to be made if the market goes back into this bubble status and starts breaking through these upper price targets like we saw after the bottom in March. So we're limiting our risk because we're setting a stop loss below support level. We've identified that the trend is indeed bullish and the correction could be ending. So now we have an educated position, we have an educated direction that the market is going, and we know our entry and exit points. So I'm going to get back into the technical analysis, but I just wanted to make that clear for all of the loyal followers of this channel. I want you to really understand the logic and the trading behind what analysis we're doing here, because you're going to benefit from this channel much more if you understand the strategy behind the analysis. All right, so getting right back into the analysis here, we do see that bullish close above the 20 simple moving average, and we are starting to see that bullish crossover of the moving averages crossing back above in the bullish direction. So in one more close above the 20 simple moving average, we'll even have that 5 EMA closing back above the 20. And now we'll start to look for buying opportunities on any dips. So we still do have this gap open down here all the way at $329. And if we do get a dip down in that position, that could be a great buying opportunity because we now know that the trend is beginning to look bullish and we want to buy off of support levels and set our stop losses below support. So right now we're fully expecting the SPY ETF to continue this bullish trend, and we're going to look at dips as buying opportunities as we begin to build a base of support and start getting ready to form this new higher high on the daily chart. But remember, none of this matters if we get rejected at this level and we come down and we form a new lower low. That will tell us that the medium-term bear trend is still the stronger trend and that we will most likely get stopped out of our position, and then we will have to get ready for these new lower price targets, which we still have price targets in the lower end down around $315 until we see this bearish trend fully snap. Once we see the bearish trend snap and we see the bullish trend developing, we will start generating price targets for you all to see to the upside. But right now, we still need to see that daily higher high close on the S&P 500 to start forming higher price targets. So all of these moving averages, including the 50, are going to act as support. And if we do break down below the 50, we still have this gap, which could act as support, and that would still be a higher low on a daily chart. So remember, this is our recent daily low, and we don't have a higher high yet. So what we're looking for is we're looking for the price action to come in here, form a higher low, and then we want to see the higher low go on and develop a higher high, and then we will have the true bullish trend that we're watching for. And then we just want to buy into that strength and we want to follow the trend because the trend will always be our friend in this situation. So next up, let's go ahead and take a look at the Nasdaq 100, and we're looking at the QQQ ETF, or the triple Qs. And we do see that the Nasdaq 100 has a very bullish trend today, closing well above that 20 simple moving average yet again. And we do see that that 5 EMA is starting to create separation from the 13 EMA, which tells us that that bullish trend is starting to pick up momentum. Now, the great thing about the Nasdaq 100 is we did get a higher high on the daily chart because we did close above our $281 level. So by far, technology is still leading the way on the charge, and we're still seeing the most strength in the tech sector right now, which is driving the Nasdaq 100 to these higher highs already, even though we haven't yet seen them on the SP 500. So on the Nasdaq 100, we are already bullish, and we're already getting ready to generate these higher price targets. Once we can get a pullback off of this impulsive move, it would be really nice to see this gap close, form that higher low, and then come back up and break back above that $281 level yet again. That will only strengthen our confidence that the Nasdaq 100 is going back into this bullish trend. And remember, there's still no reason to believe that this long-term bullish trend is not going to continue now that this ABC correction is over. So a correction is just a correction to the long-term trend, and that long-term trend on the Nasdaq 100 was definitely a very bullish trend, and there's no reason to believe that we're not just going to resume that trend. So remember, this is completely objective analysis, and we don't care about all of the noise around us about valuations and about politics. We're strictly following the price action, and we're following the trend, and that is telling us to become bullish on this market. And we want to start accumulating positions on the dips, and we want to be buying off of support while we have this strengthening bullish trend. So remember, this gap on the Nasdaq 100 closes at the $272 level, and if we could get a bounce off that level, that would be a great buying opportunity to start adding a position to the Nasdaq 100. We know that this bullish trend is not the real deal. If we start coming back down and forming new lower lows, we will still have these lower price targets until we've generated upside price targets. So if we do come back down and form a lower low, you're still looking at $259 and $250 on the Nasdaq 100. Now, those lower price targets are getting very close to becoming obsoleted, and if they do become obsolete and we start generating upside price targets, we'll have them right here for you on the stocks channel. Next up is the Dow Jones Industrial, and we're looking at the DIA ETF, and we see that the Dow Jones also closed back above its 20 simple moving average for 2 days in a row now. And we did see that 5 EMA break back above the 13 EMA today. So now all three indices, the S&P 500, the Nasdaq 100, and the Dow Jones, are showing that that short-term bearish trend has snapped, and we're now showing a short-term bullish trend developing. So this is an exciting time in the stock market. These are where you want to be trading because you want to be looking for buying opportunities while we're identifying a trend shift. So we do have a buying opportunity on the DIA ETF at this gap closure, which would bring us down to 272. So remember, that would still be a higher low, and we still have an opportunity to come up here on a higher low and try to form a higher high, breaking back above 282. So we can see that the Nasdaq 100 is by far looking the strongest, and the Dow Jones and the S&P 500 look to be following right behind the strength of the Nasdaq, and they look like they're ready to start forming bullish trends as well. So overall, if you're a bull, this is exactly what you want to start seeing, and you really want to start getting ready to buy on these support levels because that is exactly what this bullish trend is telling us to get ready to do. Next up is the VIX, which is our fear indicator, and we see the VIX closing up 1.25% today, but we can see that the VIX is really just flatlining right around this $26 level, and we really don't know if the VIX is going to break to the upside or the downside. But with the market going higher, we would expect to start seeing the fear leaving the market, and the VIX would start heading lower. Now, if we start to see a spike in the VIX, that will be a warning sign that maybe we're not really out of the clear yet on that bearish trend, and we still have more downside coming. But right now, the VIX is at an elevated level, which could be another indication that the market could go sideways. So remember, sideways is always an option, and sideways is always a great opportunity as a trader, because that means we're getting opportunities to buy and sell into the strength and the weakness, and sideways is still an opportunity to make money as long as you're trading the strength and the weakness. So with the elevated VIX being at 26, it's very real possibility that we start heading sideways and we start bouncing off of very well-defined resistance and support levels, which would open up great trading opportunities as a stock market trader. So let's take a quick look at some of the sectors driving the market. And first up, we do have financials, and we see financials close back above its 13 EMA yet again, but it's still finding resistance at that 20 simple moving average in the 50 EMA. So overall, as a stock market bull, we don't want to see the financials struggling. And we really want to see the financials form that higher high and that higher low and start to snap this bearish trend. So the financials still have that bearish trend, and we know that because the price action's closing below the 20 simple moving average, and that 5 EMA is still trading below that 13 EMA. So there's no guessing, and we know that the trend is bearish, and we also see that the price action is telling us that there could be more downside. So we don't want to see the financials struggling if we want to see the S&P 500 go to new all-time highs. So we need to keep a close eye on the financial sector. Next up is the industrials, and we also see bad news with the industrials with them closing below the 5 EMA, and we still have the price action closing below that 20 simple moving average, and that 5 EMA is still downward trending below the 13 EMA, which tells us that the trend is still bearish. So again, not great news to see the financials and the industrials still struggling in a bearish trend, and that will start to hold the S&P 500 back. However, tech is looking very strong, and we could still have tech lead the charge and carry the S&P 500 higher, even though the industrials and the financials are struggling. Next up is the healthcare sector, and we do see the healthcare sector following through with that bullish trend. And we did have a close above the 20 simple moving average in the 50 EMA for a second day in a row, which has also allowed that 5 EMA to close back above the 13 EMA, showing us that that short-term bearish trend is ending. So technology and healthcare look like they're going back into a bullish trend, but we still do have a struggling financial and industrial sector that we want to see snap their bearish trends as well, so that we can get fully bullish on the S&P 500. Next up is the US dollar, and we're looking at DXY, and we see the US dollar still trending downward in its upward trend, coming right down to the 20 simple moving average and finding support. So remember, with the US dollar, we could come all the way down to our support trend line and still form a higher low and stay in a bullish trend, but it's still a few days away from testing that support level. And we're seeing the stock market take advantage of the weakness in the dollar, because as the dollar is taking a second to cool off, we see the stock market heading higher. So remember, if the dollar shows strength, we expect the stock market to correct. But right now, while the dollar is showing weakness, we're seeing the stock market go back to being bullish. Now, whether or not that relationship is going to remain inverse is yet to be determined, but we're going to take advantage of that relationship while it's there, and we're going to continue to monitor the US dollar. Next up is gold, and gold's doing almost exactly what we expected after breaking down through support, and it's coming back up and testing support as resistance. I would expect to see it get rejected at this resistance level if we're going to see the dollar resume its bullish trend, and I'm still looking to be a buyer of gold down here at the next support level of $1,800. So we expect gold to go higher as the dollar goes lower, and that's exactly what we're seeing, but we're also seeing the dollar come into a support level as gold goes into a resistance level, and I have to give benefit of the doubt to the dollar because it's in a bullish trend, and that would mean gold is going to head lower. So we're still looking to be a buyer of gold down here at a lower price target of 1800. Next up is Apple stock, which is our market moving stock, and we see Apple continuing its bullish trend, closing back above the 20 simple moving average yet again. And we're starting to see separation of that 5 EMA above the 13 EMA, which means that that short-term bullish trend is picking up momentum. Remember, we still have a medium-term bearish trend, which is that negative sloping 20 simple moving average. So it's too soon to get too bullish on this market, but it's definitely looking like the technology sector and stocks like Apple are getting ready to head back into a bullish trend, at least in the short term. So if you're going to be a buyer of this strength, remember to buy off support levels and set your stop losses. In any event that medium-term bearish trend takes over, we will have protection to the downside. Next up is Tesla, which, as you know, we like to call our FOMO stock, and we see Tesla breaking out of our consolidation wedge pattern to the bullish side with yesterday's close, and we do see follow through with the price action closing up over 4.4% today. So I'm still expecting Tesla to come up here and attack these previous all-time highs at $500. And remember, this could be a great trading opportunity. You could buy Tesla off of support levels, and you know your price target is up around the $500 level. You know you're wrong if we break down below the 20 simple moving average, and that's where I would have my exit. In any event I do make a trade on Tesla, I always want to know where my downside risk is, and I want to position my trade size accordingly. So Tesla is looking bullish. We see that 5 EMA above the 13, and we see consecutive closes over that 20 simple moving average. So there's no reason to believe that Tesla is going down anytime soon. And as we know with FOMO stocks, they can go parabolic and go vertical in a heartbeat. So I wouldn't be surprised to see Tesla come back up to this $500 level very soon. Next up is Bitcoin, and we see Bitcoin starting to head into a consolidation wedge where we see that the price action is starting to head lower, but we are staying above support level. So we do want to wait and see if Bitcoin's going to break to the bull side before becoming a buyer, and I would like to see Bitcoin break that $11,000 level and get back up here and start attacking $12,000. So overall, the bulls are still in control of Bitcoin, but it is in a consolidation wedge pattern, and we always know in a consolidation wedge pattern We want to wait to see if it's going to break to the bull side or the bear side before we become too bullish. So to pull this all together, don't forget to manage your risk and reward. I can't stress that enough. You need to understand your reward to your risk levels, and you always want to take trades that have more reward than risk. So we're identifying a bullish trend developing, which means we want to be a buyer of the dip very soon, but we want to ensure that that dip is the real deal dip and it's going to find support. So we want to buy on the bounce. Never try to catch a falling knife. We never want to buy while the stock market is tanking. We want to wait for that support level to show up as support, and we want to buy on the bounce, and we want to set our risk below support. So remember, on the SPY ETF, hopefully we could come back and break above the $342 level and form that higher high on the daily chart, and then we're going to start becoming very aggressive on the bull side, and we're going to start buying up the dip. So please remember to help me out by smashing that like button on this video. I really hope these videos are helping you out, and if you haven't already and want to follow along with all of my updates, go ahead and subscribe to the channel right now. Thanks for watching, everybody, and as always, I will see you in the next episode.